Hello, my name is Wilfred Hahn. I'm Global Strategic Advisor and Portfolio Manager for Forstrong Global. I want to talk to you today about a prickly four-letter word that many investors tend to ignore or avoid. Sometimes they actually fear this word. It's the word risk, and actually it represents a vital dynamic to positive investment returns. In other words, handled right, it is a beneficial concept, and that's what we want to talk about. In recent decades, organizations and corporations have adopted strong cultures of risk management. Risks here are defined as possibly an event that impairs the value of an investment or indeed the operational viability of the entire corporation or entity. For example, the World Economic Forum, which has as its members 1,000 of the largest corporations in the world, publishes an annual report of its assessment of risks. It's called the Global Risk Report. It's a very interesting read, and the type of things that they cover are risks ranging from new biological engineering, perhaps causing a major pandemic, to the impacts of natural geophysical catastrophes. So they cover the whole waterfront of risks. Most of these risks that they would cover can have an impact on investment portfolios and the success of our investment policies. However, as portfolio managers, we're most concerned about understanding financial risks. In our view, knowing the price of risk is essential to making investment decisions. Sometimes risk indeed does keep us up awake at night. We're paid to be worriers. After all, it's not always easy to see where the risks are and to identify them. They're a bit like a chameleon. They're sometimes indistinguishable from the background. Did you know that there is such a thing as the price of risk? That's something we look at very closely. Cheap risk can facilitate attractive investment returns. That's where this beneficial side of the word risk comes in, and we want to emphasize as I present on this topic further. However, on the other hand, expensive risk can lead to poor investment results, and that kind of risk is the risk that investors should be scared of. Well, can I illustrate a type of expensive risk? For example, if one buys an investment that has much downside at a high valuation, you will have bargained for much risk with little prospect of positive returns. That's what we call expensive risk. It often occurs when investments become very optimistic. Sometimes it's very difficult to see potential negatives on the horizon. Investors may interpret the sharp rise in equity and bond markets as representing low risk. But more likely, not always, but more likely, it can be the exact opposite that's occurring. Markets are becoming riskier as they rise higher and become more expensive. Now, believe it or not, there have been times when investors have been so euphorically upbeat that they have paid up front to lock in negative returns. That's hard to understand, isn't it? Such as also, for example, negative interest rates that we have in some parts of the world today. But this actually happened back in 2006, 2007. Risk was actually negatively priced, and unfortunately, of course, when you do that, one gets the bad side, the dirty four-letter word side of risk. Now, as a professional myself, working in financial markets almost 4 decades, I can tell you that I get really nervous when investors can see no risks on the horizon. When there's this, no more of this proverbial wall of worry to go up for markets. And when you get those conditions, it's an indication that financial assets are being priced for a perfect future, like 100% perfection in the future, and that there's only probabilities of positive things happening. Well, that's not usually good when those kinds of conditions come about. In addition, at these kinds of times, there can be a diabolical, sort of an infectious psychological effect at play at those times. Investors begin to start chasing returns, running in herds, and they're assuming at that point in time that past gains signal high return, low risk gains. But the actuality is very much the opposite in most cases. There eventually does come a point where an optimistic consensus view can no longer be extended. All of what I've recounted to this point is not new. It's largely the result of normal human behaviors and normal human proclivities. As I said, there's nothing new here. But from time to time, there are financial technologies that come to interplay in the pricing of markets and in the development of the positive psychology at that time. And these might be financial instruments and new strategies, for example, that become very popular. And when these play out, they can have an exponential impact on the instability of financial markets. And that's what we have to watch in addition to, at least to calculate what this bad side of the risk is. And quite in fact, these derivative type factors are again at play today, and we want to keep well informed of those. For example, fund managers these days have sought to hedge against downside risks, offering portfolios that apply risk parity type of strategies, and there's various others. And again, they're of a derivative nature. So when you get a very crowded trade in these types of transactions, some analysts suggest there's about $2 trillion worth of portfolios managed out there in the world that have some kind of element of these derivative protections in them. What actually really happens is risk overall is actually higher than people think. And as I say, that's sort of what's at play now internationally, and something that we need to watch very carefully. That leads to the question, just how cheaply is risk being priced these days? One indicator that's frequently and popularly used to calculate that is called the Vix Indicator. Now, it's only measuring one kind of risk, but it's definitely illustrative. It's known colloquially as the fear index. The Vix measures financial market sensitivity to uncertainty. What we mean here, the perceived probability of a large fluctuation in the value of stock markets. Again, that's one form of risk, as say conveyed by stock index option prices. A low Vix signals often a speculative or bullish period when investors reach for yield and returns. A low VIX signal, as I said, is a dangerous indicator and an indication of just how far that risk has fallen, or should the valuation of that risk has fallen. We provide you with a chart here. You'll see that here in a moment on the back screen. The VIX indicator is nearly at an all-time low, meaning it's valuing risk very, very cheaply these days. One of the most famous behavioral economists, called Daniel Kahneman, Dr. Daniel Kahneman, had this to say about risk. Courage is the willingness to take the risk once you know the odds. Optimistic overconfidence means you are taking the risk because you don't know the odds. There's a big difference. And that's exactly what we're talking about here. We want to be sure that we know what the odds are and therefore what the price of the odds are. It's absolutely essential to have that information to make investment decisions. We prefer to know what the odds are. As well, some very reputable analysts are arguing today that investors are again in an environment where risks are mispriced. And quoting another reputable analyst, he says, volatility, again, which is a form of risk, is the most undervalued of all assets right now. So that actually twigs us to an opportunity that we can take advantage of here in the future, and I'll talk about that. So how do we handle risk? When will we be able to capitalize on the beneficial kind of risk? That's at times where risk is priced very cheaply. Recently, we have again been responding to the heightening financial risks and lowered return prospects over the next quarter or so. And so we have cautiously begun to de-risk client portfolios. This can be done in a number of ways, most significantly by raising cash levels. There's additional ways as well, which we are pursuing. And we anticipate that we'll continue to do so progressively. We're not going to do it all in one big jump. Our nature is to do things gradually and responding to overall market conditions and do it that way. And that's worked for us very, very well in the past. What we strive to do, we want to achieve low drawdown risk in our portfolios. And what that means is that when markets do hit some inclement weather, which happens from time to time, it's unavoidable, we want to make sure that our values, the values of our portfolios don't fall as much. So in other words, adjust less. And that's what it means to have low drawdown risk. We have achieved this characteristic in the past with our portfolios, And our clients really appreciate that dynamic about our portfolios. We want to work hard to continue that characteristic. Of course, having said that, it's easy to say, but hard to do. Short-term timing is involved sometimes, and of course that's very, very difficult to do. But that's why we approach things from a progressive point of view. As risk prices go up, we gradually lean into it and hope to look for opportunities down the road. October 19th just passed. I think everybody will remember October 19th back in 1987. 30 years ago, the largest crash in history occurred on the New York Stock Exchange. The Dow Jones Index at that time dropping 23% in one day. I remember that day really well. I was pretty awestruck and glued to my Quotron terminal, just watching what was happening. At the time, I was a research director for a major Wall Street firm. And thinking back to what happened then, we again find one of those periods of time where people wrongly calculated the value of risk. In addition, there were some derivatives strategies that were involved as well at the time called portfolio insurance. But, in retrospect, that decline of 1987 was a time of great opportunity. Why? Because markets again put a high value on risk, meaning here again, for any given investment strategy, the markets were then giving you the high probability of high returns if you would take on a little bit of risk. We love times like that when risk is cheaply priced, and that again is why we use that concept of risk for that beneficial side of it. In conclusion, we hope to be the beneficiaries of the four-letter word again sometime in the near future. But mainly, again, the bottom line, and in conclusion, that we really wanted to point out is for investors to look at the other side of the word of risk. And again, the bottom line here that we pursue is the positive side of risk. Thank you very much.